Everybody wants to know how to grow a small trading account fast, and I get it. There's something magnetic about the idea of taking a few $100 and flipping it into something life-changing. It's the dream of every aspiring trader, to escape the grind, to prove the doubters wrong, to finally make it in a way that feels almost cinematic. But here's the problem. The word fast is poison. When most people hear fast, they imagine luck, shortcuts, or that one perfect trade that turns them into the main character of a Wall Street movie. They think trading is a game where you just pick the right ticker, hit a couple home runs, and suddenly you're free from your job, paying off your debts, and booking flights to Bali. The reality couldn't be further from that. If you really want to grow a small account, and yes, even grow it fast by realistic standards, you first have to accept one brutal truth. The majority of the work you'll do in the beginning will make you zero money. In fact, it might even feel like you're wasting your time. That's exactly why most traders quit before they even get going. This is the Sci-Fi Trading Channel, where we explore the hidden side of markets and the mind. Today, we're diving deep into what it actually takes to grow a small trading account fast. We share stories and leave you with practical advice that you can apply to your own trading right away. Sit back, relax, subscribe so you don't miss the next one, and let's dive in. Think about it like this. When you first step into the market with a small account, your dollars aren't your most valuable asset. Your habits are. The wins you get in the early months are tiny. The losses sting more than you want to admit. And at the end of the week, the money barely moves the needle in your actual life. That's because the point isn't the money. Not yet. The point is to build the foundations that will scale with you. Sticking to one strategy, even when you're tempted to chase shiny new ones. Logging and journaling every trade, so you can see your patterns in black and white. Reviewing your data instead of spending your Saturday nights scrolling for someone else's secret setup on TikTok. It's boring, it's unsexy, and it's the exact phase most people try to skip. But that boring work is what actually gives you a shot at growth later. Let me frame it this way. Imagine someone told you, in 24 months, if you follow this plan every week, you'll be making $50,000 a month on average. But for the next 24 months, you won't make a penny. Would you still do it? Most people would nod their head and say, of course, I'd wait 2 years for that. But here's the reality. The second they hit month 3 without seeing results, they give up. They convince themselves they're wasting time. They go back to chasing random trades, gambling position sizes, and hunting for that mythical secret pattern that promises overnight riches. It's no different than signing up for the gym in January and expecting a six-pack by Friday. You can't skip the sweaty, sore, confusing phase where you wonder if you're even doing it right. The boring phase is where most traders disappear, but it's also the only way forward. And this isn't just theory, history proves it. Jesse Livermore, the legendary trader who made and lost multiple fortunes in the early 1900s, is remembered as both a genius and a cautionary tale. He turned early wins into huge sums, but because he never mastered patience and discipline, he also blew up spectacularly. His story shows us that early money without psychological maturity is a curse. It creates the illusion that you've figured it out, when really you've just been lucky on borrowed time. Now compare that to someone like Tudor Jones. Jones became a legend because he obsessed over protecting capital first. He wasn't seduced by fast, he was seduced by survival. That humility allowed him to grow into one of the most consistent traders of all time. Two different paths. One burned bright and collapsed, the other compounded steadily for decades. So here's the question. How do you make sure you're not Livermore, chasing fast growth only to destroy yourself? And instead, start building like Jones so your growth is not only real, but sustainable. The answer lies in understanding what actually makes a trading account grow fast. And spoiler, it's not winning more trades. If you can stick through the boring, unsexy, unpaid phase, if you can resist the temptation to chase dopamine hits and ego boosts, then you'll hit a moment where the growth suddenly feels like it accelerates. That's when the work you did in silence finally starts to pay. But to reach that moment, you need to rewire how you think about fast in the first place. When you first open a trading account, it's hard not to imagine yourself hitting that one big winner that changes everything. Social media feeds it. Headlines feed it. Even movies feed it. We've been conditioned to believe that trading is about catching lightning in a bottle. And sometimes that illusion is reinforced by real stories. A meme stock trader who turns $5,000 into $2 million. A crypto investor who buys the right token at the right time. These stories explode online because they're exciting, but they're also incomplete. What you don't see are the thousands of traders who blew up trying to do the same thing. The desire for fast growth is deeply psychological. Our brains are wired for dopamine, the chemical hit we get from excitement, novelty, and reward. When you double an account overnight, it feels euphoric. It validates you, it tells you that maybe you're special, maybe you've got the magic touch. That's why most traders fall for it. They confuse the high of a quick win with the foundation of a sustainable strategy. But dopamine highs don't compound, habits do. Take Jesse Livermore again. He was brilliant at spotting opportunities. He made millions by shorting markets when others panicked. In 1929, during the crash, he was on top of the world. But here's the dark truth. His wealth never lasted. Because after every big win, he chased the next one. Bigger size, bigger bets, bigger risks. His need for fast growth became his downfall. He lived the illusion, the belief that one more big trade could lock in his legacy. Instead, it destroyed him. Now, fast forward to today. Scroll through TikTok, YouTube, or X, and you'll see modern versions of Livermore's story. Screenshots of huge gains, claims of turning a tiny account into six figures in weeks. The problem is, you're only seeing the highs. You're not seeing the blowups, the margin calls, the accounts wiped to zero. And because the losses don't go viral, you get a distorted picture of what fast growth really looks like. It's like looking at casino winners without seeing the millions of losers in the same building. Let's make this relatable. Brian opens an account with $500. He knows nothing about risk management, but he gets lucky. His first few trades win. Then he stumbles into a volatile stock that doubles in 2 days. Suddenly, Brian's account is at $2,000. He feels unstoppable. He thinks, why would I waste time on boring setups when I can just find another rocket like this? So he bets big again. But this time, the market turns. His sure thing collapses. He freezes, unwilling to cut the loss. By the time he sells, his account is back to $500. Or worse. Brian experienced the illusion of fast growth. He thought he was on the path to freedom. Instead, he was just on the path to wiping out. Here's the paradox. Early wins are often more dangerous than early losses. Losses force you to reflect. They make you cautious. They push you to ask, what did I do wrong? Wins, especially fast wins, inflate your ego. They trick you into thinking you found the shortcut. They blind you to risk. That's why so many traders blow up right after their first streak of success. It's not that the market suddenly got harder. It's that their psychology couldn't handle winning. Now contrast Brian with Tudor Jones. Jones became a billionaire not by chasing fast wins, but by obsessing over protecting capital. His philosophy was the opposite of Brian's. Survive first, grow second. He once said, don't focus on making money. Focus on protecting what you have. That humility is why he's still around decades later, while countless fast growth traders disappear. The illusion of fast growth doesn't just cost you money. It costs you time. Every time you blow up an account chasing speed, you set yourself back months, sometimes years. You have to rebuild capital, rebuild confidence, and start from scratch. Ironically, this makes your journey slower than if you had just focused on steady growth from the beginning. The lesson is simple. Fast growth isn't about speed. It's about acceleration. Real acceleration comes from compounding, stacking consistent, controlled gains over time. It looks boring in the beginning, but over months and years, it snowballs faster than you ever imagined. And that's exactly what we'll dive into next, how to survive the boring grind phase that most people can't handle, and why it's the secret to actually growing a small account fast. Most traders never make it past the grind phase. That's the stretch where it feels like you're putting in work but getting nothing in return. You're logging trades, building habits, showing up every day, and yet your account barely moves. It's exhausting, and it's the reason so many quit before they ever give themselves a real shot. But here's the secret. The grind phase is the most important part of your entire journey. When you're starting small, the dollars don't matter. A $20 win doesn't change your life. A $50 loss feels heavier than it should. If you measure your success by money at this stage, you'll convince yourself it's all pointless. That's why people bail out. The real payoff is delayed. The habits you build now when the money feels small are the exact same habits that will allow you to handle bigger size later. Think of it like training with weights. If you can't stick to your plan with a $500 account, you'll fall apart with a $50,000 account. The numbers change, but your brain doesn't magically rewire itself just because you're trading more dollars. And this isn't just my opinion. Look back at some of the legends. Paul Tudor Jones famously obsessed over protecting capital in his early years. He didn't care about getting rich overnight. He cared about survival, about building the discipline that would keep him in the game for decades. That's the same mindset you need in the grind phase. Less about making money today, more about building the person who can handle money tomorrow. Of course, the grind feels boring. That's why your brain resists it. Our brains crave dopamine, the quick hit from excitement, novelty, reward. That's why gambling feels fun, and why chasing new strategies every week feels tempting. Journaling your trades, reviewing your mistakes, following the same plan day after day, it doesn't give you that dopamine hit. It feels like homework. But it's exactly what separates traders who survive from those who vanish. Let me give you a picture. Imagine two traders start with the same account size. One spends their nights chasing setups on social media, convinced there's a shortcut if they just find the right indicator. The other spends their nights reviewing their trades, logging data, building self-awareness. A year later, the first trader has probably blown up and restarted 3 times. The second trader might still have a small account, but they've built a foundation that's unshakable. Guess which one has the better shot at growing fast in the long run? And here's the psychological trap. When you're in the grind, your brain tells you you're wasting your time. It whispers, "Why am I working this hard for $20 a week? Why not just go all in and try to speed it up?" That's the same voice that destroys accounts. I've seen it play out 100 different ways. A fictional trader like Alex spends months building habits, logging trades, refining his setup. He feels like he's moving slow, but the data shows progress. Another trader, Brian, gets bored after a few weeks and chases action. He makes quick money, but he can't hold onto it. 6 months later, Alex is still standing, still learning, still compounding slowly. Brian is back at zero, frustrated, telling himself the game is rigged. The grind phase isn't punishment, it's preparation. It's the market's way of testing whether you're serious enough to stick it out when it feels pointless. Every skill you need later, discipline, patience, risk management, is forged here when the stakes are small. Think about Jesse Livermore again. His downfall wasn't technical, it was psychological. He never learned to respect the grind. He chased fast wins, scaled recklessly, and let his ego drive. Compare that to someone like Seykota, who designed systems specifically to keep himself out of his own way. One man was undone by impatience. The other built processes that forced him into consistency. That's the choice you face in the grind. You can either see it as wasted time or see it as building the version of yourself who can actually handle fast growth later. The boring work is the real work. Logging trades, journaling emotions, reviewing charts, sticking to your system for 100 trades before you even think about tweaking it. Nobody's posting about that on Instagram, but that's the stuff that creates compound growth. And so if you're 3 months in, staring at your account, wondering why you're spending hours for a $12 day, remember this: you're not building for today. You're building for the days when your size is larger, when that same $12 move becomes $1,200. The dollars come later, the habits come now, and once you accept that, you'll realize that the grind isn't a detour. It's the only road forward. One of the biggest traps for new traders is not losing early. It's winning early. Nothing inflates the ego faster than a streak of quick wins, and nothing sets a trader up for disaster faster than believing those wins mean they've figured it out. When you start with a small account, a lucky streak feels like proof you've cracked the code. You double your account, maybe even triple it, and suddenly your brain tells you you're special. You start imagining quitting your job, trading full-time, scaling to 6 figures in months. It feels amazing, but it's an illusion. Because early wins don't test your discipline. They don't build your process. They don't prepare you for the inevitable losses. Early wins are the worst teacher because they teach you the wrong lesson, that trading is easy, that you can bend the rules, that your emotions won't get in the way. That's exactly what happened to Jesse Livermore. He was famous for making and losing fortunes multiple times in his life. After the 1929 crash, he was one of the richest men in the world. He shorted the market while others panicked and walked away with more than $100 million, an unimaginable sum at the time. But he couldn't hold on to it. His ego grew with every win. He oversized positions, broke his own rules, and chased the thrill of being right. Eventually, the same ego that made him millions destroyed him. Livermore's story is dramatic, but it's not unique. You see smaller versions of it every day in modern trading. Take a fictional trader like Brian. He starts with a $1,000 account. By sheer luck, his first two trades double his money. Now he's sitting on $2,000 and thinks he's unstoppable. Instead of keeping his risk small, he goes all in on the next setup. This time, it fails. His account drops back under $1,000. Frustrated, he tries to make it back fast, doubling down again. Within weeks, he's blown up. Brian isn't alone. Most traders experience some version of this. The danger of early wins is that they trick you into believing you're further along than you really are. They inflate your confidence without testing your discipline. And discipline is what keeps you alive. Contrast that with someone like Tudor Jones. When he was early in his career, he didn't let wins inflate him. He was famous for his obsession with risk. He said his goal wasn't to make the most money, it was to protect the money he already had. That humility is why he survived long enough to become a legend. The lesson is clear. Don't let early wins rewrite your rules. Don't let ego convince you that risk doesn't apply to you. The same setups that gave you a streak of winners will eventually hand you losses. If you're not disciplined, those losses will erase everything you built. It's the same in life. Think about the lottery winners who go broke within a few years. They mistake a sudden windfall for skill, and they never build the habits to sustain it. Trading is no different. A sudden hot streak doesn't make you a great trader. It just makes you vulnerable to the next hit of reality. And here's the cruel part. Your brain loves early wins. They feel like validation. They feel like proof that you found the shortcut everyone else missed. It's intoxicating. That's why ego is so hard to fight. But the traders who last are the ones who don't let wins define them. They treat wins the same as losses, just another data point in a long series. That's how Seykota thought. He knew that the market was random in the short term, even with a system. One win didn't mean anything. One loss didn't mean anything. What mattered was the process over hundreds of trades. That mindset is what separates professionals from amateurs. Amateurs let wins inflate them and losses crush them. Professionals see both as part of the same cycle. So if you're in the middle of an early hot streak, here's the advice. Don't celebrate too hard. Don't size up overnight. Don't change your process because you think you've leveled up. The real test isn't whether you can win when the market hands you easy setups. The real test is whether you can stick to your rules when the market inevitably turns. Because the truth is, your first wins aren't the beginning of a new lifestyle. They're the beginning of your first psychological battle. The phrase grow fast makes most people think about speed. But in trading, fast growth isn't really about speed. It's about acceleration. Controlled acceleration. There's a difference. Speed is reckless. Acceleration is intentional. Here's the problem. Most traders skip this distinction. They hit a winning streak and immediately double their size. They go from risking $50 a trade to $200 overnight because they think their skills leveled up. But trading doesn't work like a video game. You don't suddenly unlock bigger size mode just because you had a good week. What actually happens is psychological overload. Suddenly the same setups that felt comfortable now feel massive. A $10 move against you that used to sting a little now makes your palms sweat. The pressure hijacks your brain. You start cutting winners too soon, letting losers run too long, and second-guessing every click. That's why most traders blow up right when they think they're ready to grow. The right way to grow a small account fast is to scale slowly, so slowly that your emotions barely notice the change. If you're risking $20 a trade comfortably, move to $25, then $30. Let your brain adjust at each level. The goal is to build confidence and consistency at a size that doesn't overwhelm you, then expand gradually. That's how compounding actually takes root. Stanley Druckenmiller, one of the greatest traders of all time, understood this balance better than anyone. He was famous for conviction. When he believed in a trade, he sized up big. But even he admitted that one of his worst mistakes came during the dot-com bubble. He knew tech stocks were in a mania, but near the top, he caved. He bought heavily, overextended, and lost billions when the bubble burst. His lesson was clear. Conviction without control is recklessness. That lesson applies perfectly to growing a small account. Having confidence in your system is good, believing in your edge is good, but if you jump size too fast, conviction becomes arrogance, and arrogance kills. Let's make this real. Imagine a fictional trader named Rachel. She starts with a $1,000 account. She builds a strategy, journals every trade, and proves over 100 trades that her edge works. She's making about 5% a month. Not life-changing yet, but consistent. Instead of doubling her size overnight, she scales slowly. 1 month, she risks $20 a trade. A few months later, she risks $25, then $30. By the time she's trading with $5,000 in her account, she's completely comfortable risking $100 per trade. The size has grown tenfold, but emotionally, she doesn't feel the difference because she scaled at the pace her brain could handle. Now imagine another trader, Jason. He also starts with $1,000 and gets hot right away. After a few good weeks, he doubles his size overnight. Suddenly, he's risking $200 per trade. At first, he feels bold, but the second a trade goes red, panic takes over. He can't sleep, he can't think straight, and he starts breaking every rule. Within a month, he's back under $500. Jason thought he was speeding up growth, but really he just sped up his own destruction. That's the paradox of controlled acceleration. Going slower in the short term actually gets you to your goal faster, because you're not wasting time digging out of massive holes. Think of it like compound interest. If you have $1,000 and grow 5% a month, that's $50. Not exciting. But after 24 months, with compounding, that account is nearly $3,200. Now 5% is $160. Another year, and it's over $5,500. And 5% is $275. Same percentage, bigger dollar amount. That's acceleration. The money builds on itself. But only if you stay alive long enough for it to work. This is why the phrase fast is so misleading. The traders who actually grow accounts quickly are the ones who respect slow scaling. They treat growth like building muscle. Steady reps, steady progress, letting the gains compound over time. The ones who chase fast without patience end up like lottery winners who are broke again in a year. The market rewards patience paired with discipline. It punishes recklessness disguised as ambition. Druckenmiller proved that even billionaires can stumble when they push too fast. Retail traders with small accounts don't stand a chance if they don't respect that lesson. So if you want to grow your account fast, focus on controlled acceleration. Prove your edge with small size. Scale gradually. Let compounding do the heavy lifting. That's how you grow fast without blowing up. Most people think the secret to growing an account is hidden in strategies, setups, or indicators. But here's the uncomfortable truth. The real work that builds a trading account is the work nobody brags about. It's not glamorous, it doesn't look good on Instagram, and it won't get you clout on Twitter. The hidden work is tracking, journaling, and reviewing. If you're not logging every trade, you're flying blind. You might think you know what's working, but your memory is biased. You'll remember the wins that felt good and forget the losses that embarrassed you. You'll tell yourself a strategy is solid when in reality it's leaking money slowly. The only way to know the truth is to write it down and review the data. Ed Seykota, one of the pioneers of computerized trading, said it best: everybody gets what they want out of the market. What he meant was, if you want emotional comfort more than you want profits, you'll trade in ways that give you comfort, even if it destroys your account. You'll cut winners short because it feels safe. You'll hold losers because it feels better than admitting you're wrong. And you'll never actually face your patterns, because that would force you to confront your own flaws. Journaling takes away that excuse. It forces you to look in the mirror. Take a fictional trader like Alex. Alex swears his breakout strategy is profitable. He's confident that he just needs more capital. But when he finally journals 50 trades, he realizes something brutal. His edge isn't the breakout. It's actually the retest after the breakout. He's been losing money on half his trades without even realizing it. The data doesn't lie. Once he focuses only on the retests, his results flip. Now compare him to another trader, Kevin. Kevin hates journaling. He thinks it's a waste of time. He'd rather spend those hours watching videos and chasing setups on social media. After 6 months, he feels stuck. His account goes in circles. He doesn't understand why. The answer is obvious to everyone but him. He refuses to track his trades, so he's blind to his own mistakes. That's the divide. Alex builds awareness, Kevin stays in denial, and only one of them has a chance to grow. The hidden work isn't just journaling trades, it's logging your emotions too. Did you hesitate on the entry? Did you exit early out of fear? Did you size up recklessly after a win? These patterns matter more than the charts, because in trading, your psychology is the strategy. The reason most people avoid this work is simple. It doesn't give them dopamine. It feels like homework. It's quiet. It's repetitive. There's no thrill in writing down that you made the same mistake 3 days in a row. But those boring notes are gold. They're the map of your own psychology. And here's the kicker. When you finally do start journaling, you'll realize how much of your trading wasn't based on strategy at all. It was based on impulse. That realization stings, but it's also liberating. Because once you see your patterns, you can change them. Ed Seykota understood this decades ago. That's why he built systems, to remove as much of his own emotion from the process as possible. But even then, he knew traders would sabotage systems if they weren't honest about their emotional needs. That's why he said, we all get what we want. The data doesn't lie. Your journal will tell you whether you want comfort or profits. Think about it like training for a sport. The flashy highlight plays happen on game day, but the real improvement happens in practice, in the hours nobody sees. Journaling is practice. Reviewing your trades is practice. It's not exciting, but it's where the growth happens. The irony is that the hidden work doesn't just make you better, it makes you faster. Traders who log and review accelerate their learning curve. Traders who avoid it keep repeating the same mistakes for years. So the ones doing the boring work actually grow accounts fast, while the shortcut chasers stay stuck. If you want proof, just ask yourself this. How many times have you repeated the same mistake, swore you wouldn't do it again, and then did it anyway? That cycle never ends until you start tracking, because until you see it in writing, your brain will keep lying to you. Growing a small account fast doesn't come from flashy trades. It comes from boring spreadsheets. It comes from honest notes about your fear and greed. It comes from building a feedback loop where you learn faster than the average trader. Most people won't do it. That's why most people fail. But if you're willing to, you'll separate yourself. You'll give yourself a real chance. Most beginners treat trading like a game. They chase high scores. Every win is a dopamine rush. Every loss is rage quit territory. They measure their success one trade at a time, and they act like the goal is to beat the market in a single session. But if you want to grow a small account fast, you can't treat trading like a game. You have to treat it like a business. A game is about excitement. A business is about consistency. A game is about highs and lows. A business is about process and systems. A game ends when you hit zero. A business survives as long as you protect your inventory. Your account is your inventory. It's not a lottery ticket. It's not a scoreboard. It's the raw material that allows you to participate in opportunities. Blow up your inventory and you're out of business. Protect it and you can keep compounding. George Soros understood this perfectly. He didn't see trades as proof of his intelligence. He saw them as hypotheses, ideas to be tested, adapted, or discarded. He didn't marry his trades. He didn't chase points for his ego. He managed a business of probabilities, where protecting capital came first. That flexibility is why he survived as long as he did. Stanley Druckenmiller echoed the same philosophy. He was bold when he saw opportunity, but he cut quickly when wrong. He wasn't chasing thrills. He was running a business. His conviction trades were never just about excitement. They were about controlled bets inside a system that kept him alive. Now let's bring this back to the everyday trader. Take a fictional character like Kevin. Kevin treats trading like Call of Duty. He sizes up recklessly after every win, looking for the next dopamine hit. He takes losses personally, like the market just insulted him. He's either euphoric or devastated. He's not running a business. He's playing a slot machine. Now contrast Kevin with Rachel, who treats her $1,000 account like a business. She knows her edge. She tracks her trades. She sizes up slowly. Every trade is logged, reviewed, and treated as inventory management. When she loses, she doesn't spiral. She adjusts. When she wins, she doesn't celebrate like she hit the jackpot. She just logs it and prepares for the next opportunity. Rachel grows slowly at first, but her business survives. And because it survives, it compounds. That's the difference. Treat it like a game and you'll get entertainment. Treat it like a business and you'll get growth. And here's the paradox. The fastest way to grow an account is to stop thinking about speed at all. If you think like a business owner, you stop chasing shortcuts. You stop swinging for home runs. You stop risking everything for the thrill of one big win. Instead, you focus on protecting inventory, compounding steady returns, and letting time do the work. That doesn't feel fast in the beginning, but it's the only way growth actually accelerates. Think about a small coffee shop. In the first few months, they're not pulling six-figure profits. They're refining their systems, they're tracking costs, they're learning what works, they're staying alive. If they survive those first years, they grow. Trading is the same. Your account is the shop. Your rules are the systems. Your risk management is the rent you have to pay, no matter what. Treat it casually, and you'll close shop in months. Treat it seriously, and you'll still be in business when everyone else is gone. The game rewards your ego. The business rewards your discipline. The game ends in blowups. The business ends in compounding. So here's the bottom line. Growing a small account fast isn't about chasing lightning in a bottle. It's about embracing the grind, respecting risk, scaling slowly, doing the hidden work, and treating the whole thing like a business. That path looks boring in the short term. It feels like it's dragging. But in the long term, it's the fastest road there is. Because fast growth isn't about doubling your account overnight. It's about surviving long enough to let compounding do its job. And compounding only rewards the trader who treats their account like a business, not a game. So the next time you sit down at your desk and feel the urge to swing for the fences, remind yourself, this isn't a game. This is your business. Protect your inventory. Respect your systems. Let time and discipline do the work. And when you finally hit the point where one trade pays for an entire month of your life, you'll realize the grind, the patience, the boring work, it was never wasted. It was the foundation for the kind of fast growth most traders never get to see.